Okay, it's the start of the month and therefore time to plug my Patreon service. So, if I could just take a couple of minutes of your time to explain the benefits. There are free tiers available. You can follow the link in the description box of this video and any of my videos on YouTube to come over and have a read for yourself. I won't read it to you. If you were to join the top tier, tier 3 for £15 a month, you would unlock all of the 162 exclusive posts which have been posted since the Patreon began. Most recently were my top dividend stock picks for the month of November. This is a video going into detail, it's over an hour long, looking at the stock rating system which is issued each month and the dividend calendar which is issued each month, and then I go through the ones that I'm most interested in based on company health, yield and a series of other factors. And then here's the actual dividend calendar. You can download 2 PDF files here. We've got a recent live stream and we've got a recent addition to the Elliott Wave Theory playlist as well, looking at channels. I mean, if we come over to that now, this has now become a bit of an epic series. It's now 14 videos long and it will basically teach you Elliott Wave from scratch. You'll have a pretty solid understanding of it by the time you've gone through all of these. I'm always adding to it. We also have several other playlists as well, looking at trading, basic technical analysis, how to use TradingView, some deep dives and other things like that. So thank you very much for listening. Please consider signing up. We'd be very glad to have you. And yeah, let's get back to the video. Cheers guys. Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, it's time to look at Google Alphabet, and I'm looking at the long-term chart here, which is GOOGL instead of just GOOL, because we just need as much price data as possible in order to do our long-term analysis. So we've got Google to do today, and then we've got Tesla to do, which I'm still working on at the moment, and then we've done our big five because I've already covered Microsoft, Amazon and Apple, and I think at that point we will just do an update each week on all 5 of them, bringing up the most recent price data is the plan. So let's crack on. So going through the motions, if you haven't seen the previous videos and this is your first video on this channel, let's just give you a rundown of how we do things. Basically, there's a little bit more to it than this, but this is the simplest way to go about building the long-term count. So first thing I like to do is bring up my 60 and 250 exponential moving averages on the on the weekly time frame. And then from there I like to look at the corrections I can spot in time, and essentially what I'm looking for are the longest, most obvious corrections. So we've got one here which is obviously a sharp, most likely a zigzag here, and this is 378 days. We've got one here of 182 days, one here of 153 days, one here of 175 days, one significant flat pattern here, 329 days, more time consuming. I have seen this interpreted differently as 5 up into a sharp, and this is the flat prior to it. I guess you can look at it either way. I think I prefer to look at it as an expanded flat for myself. And then we've got the most recent correction here, which is 350 days in length. So we can see the most significant corrections we've had in the history of Google are going back to the GFC 2008 to 2009, 378 and 350. Here we can also see, if we remove these corrections in time, that if we projected the 250 weekly average back, you can see with the way it's moving here, we can roughly estimate, given the way the 60 has moved up to the previous high, that that's kind of what the 250 would look like. It may be a little flatter. Either way, we can see that this correction breaks down the 60 exponential weekly moving average and would have broke below the 250 weekly exponential moving average. We then move back above the 60 and then we use the 250 support at the 2 larger degrees, 1, 2, 1, 2, I think this is. And then from that point we enter the same wave degree of a wave 3 all the way up to the current top. And here we basically bounce off of the 60 and basically spend most of our time trading around the 60. We get one test of the 250 here, just shy of it, back up, and now we're back to the 250 weekly moving average again. So that's the first thing I like to do. I then like to look at the price corrections as well and see how things look here. So let's just get the 2 moving averages out of the way. We get a 66.9% correction during the GFC, by far the biggest correction, a 31% correction, a 26, a 16, and then it's 19, 16, 23, 22, and then 44.99. So we can see that by far the largest corrections we've got is this here at 66.9 and this here so far at 44.9, and then we've got 2 larger corrections here leading into this continuous rally all the way to the highs. Having got our price corrections and our time corrections, I then like to use a little bit of geometry using the first pivot I can see, which is here, and then a secondary pivot, making the assumption due to the sheer amount of sheer amount of price data we've got here, which appears to be fractal, what we call I suspect to be a wave free extension. So essentially what we get is more and more sub-wave price action going on instead of these big pivots that we can see. So it does look like a wave free extension. It behaves like one as well. Once I've done that, I like to bring up my MACD, RSI, OBV, and then I like to look at momentum peaks and look at the peaks in the RSI, the MACD, the rollovers from the highs in the OBV, and try and line them up for where I'm going to count, essentially, or how I'm going to count this section here. Once I've done that, I then like to get a little bit of geometry on the chart, so I use this primary pivot. So I set up a pitchfork here, and we can see that if we were to turn this pitchfork into a full original, I think it is, no, full, bear with me, it's a full shift. Where have I put it? There it is. So we can see here, this is the best fit I've got. Now we are in log scale on the weekly time frame. So we can see that when we're using all of the fib levels in my fib pitchfork, this plays really well. 32, 78.6, 23.6, 38.2, median line, 50, 50, 38.2, median line, 23.6. You get the idea. 23.6, median line, 50, median line, 23.6, median line, and we just step our way in between these levels within the pitchfork, back and forth, back and forth, back and forth, and this is all one wave degree leading up to the big top, where we get this blow off move, blow off fifth in a free is how I'm looking at it. You could probably try and interpret it differently, but I think that's the best look so far. I'll wrap a cycle around it on that basis, as a cycle channel, where I'm basically saying this is the primary pivot, this is the median line and all the action around it, this is the next subsequent high, this will be the next subsequent low most likely. So we might come down all the way to the bottom of this parallel channel. We don't have to, but we definitely could. If we continue to correct, this could be a larger wave degree correction. And then once I've done that, I move into the next bracket here, which is the next pivot. 1, 2 again is how I'm counting it. So I use a primary pitchfork here. We can see that everything is contained within it up to the previous high, and we get this kind of extension, typical extension behavior, where we spend a fair bit amount of time below the pitchfork as we go 1, 2, 1, 2, 1, 2, and then we go all the way up to here. We get a back test here of the extreme out of bound. This is pretty a pretty violent move down, actually, one of the most violent ones we had since the start, but we can see how the thrust is from the extreme out of bound, 61.8, out of bound, median line, 38.2, all the way up to a double top here along the edge of the pitchfork. So I think that the shock of the breakdown in 2020 was an extreme move, COVID reaction, nobody was really expecting it. It did push things to extremes, and then the bounce back was extreme as well, and had to correct that move down, pushes all the way back up to the piece of this geometry here. And then use a channel to see how that channels. We can see that we get a beautiful 1, 2, 1, 2. We could even channel this one up as well into 3, into 4, and then we get that breakout blow off move in the 5th. And that's how I basically look at the geometry for it. And then once I've done that, I'll start with a simple idea for the count, and that's it. So we've got 1, 2, 3, 4, and then we are going to likely stay within the confines of this channel here. So that falls a little extreme. Now we don't know whether this is going to come down as a sharp or a flat pattern of some sort. Now I would expect a sideways correction here, because we had such an obvious sharp here at the wave 2 of this cycle wave degree. So I'm actually considering the possibility that this is going to be a 3-wave move, a 3-wave move, and then a 5-wave move, finishing within the prior wave 4 at the edge of the pitchfork, and this could be a multi-year correction. Now it doesn't have to be, we could come down in a hurry, in a sharp, we could go off to new highs in the 5th, but I think at cycle wave degree, in a wave 4, in what could be a sideways pattern to alternate with the sharp, this could be a very time consuming correction. it's possible. Now, but we won't know, we'll have to wait and see. I do have a count for this at the moment, we'll come in and dig into that. So once I've got my simple count down and the cycle channel down, and I've done all my geometry and that, I then go through the basis of getting the actual count done. So if we come down to the 8 hours, we can see all the nitty gritty detail, and this is how I've subdivided it to the high. Okay, so it goes basically like cycle wave 1, 2, and then we go 1, 2 primary, 1, 2 intermediate, 1, 2 minor, 1, 2 minute, 1, 2 minuet, 3, 4, 5 minuet, minute 3, 4, 5 minor 3, 4, 5 intermediate 3, 4, 5 primary 3, 4, 5 cycle 3. Okay, so that's how we go 1, 2, 3, 4 up to here. This gives us now into a wave 4, into a wave 5. Let's come down to the 4 hour or to the chart and get into the more recent price data here. We'll have a quick look at the count I've got here. I'm not 100% on it. We'll do some classical analysis with our indicators for support and resistance and that as well. See how things look. This is starting to look a little overdone in the shorter term in terms of being a bit oversold. So we can talk about what that means for the longer term count in a moment. Let's just bring up the actual correction I've got here so far. So I'm viewing this as a double zigzag. There is an argument to say you could just view it as an impulse, but if we try to count it as an impulse, then we're locking ourselves into a zigzag pattern, because a zigzag starts with 5 and the retracement in the B is likely to be more limited than it would be in a flat. If we break it down into what I think looks better from a structural point of view, into a series of zigzags, that allows us to potentially complete a 3 wave move, right, of 2 zigzags, which allow us to expand price data correctively over a much more extended time period, and potentially even get a new all-time high, and a significant one at that possibly, which is actually corrective and not impulsive. That would be a big... Oh, you wouldn't want to miss that rally regardless. You take it, but I'm saying it could be a big bull trap because people have a really bad habit of buying breakouts rather than retracements, and a breakout in the B wave is the ultimate screw you. It's the ultimate way of fucking people over. I see it all the time, small time frame, large time frame. People are far too interested in buying breakouts than they are in buying retracements. The whole point of buying a retracement safely is to establish support, move off of the low impulsively, move back to support, have a first high and higher low, and then buy off of that pivot, rather than waiting for a level to break. That's just my personal opinion. You can trade however you want, but either way, getting back to the point, ABCW, ABCX, ABC underway to complete the Y, not quite done yet. I can only see 1, 2, 3, 4 waves, and this might be 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 5, and might be subdividing into a third wave extension within the C of the Y of the A here. Now it could be done, right? You might say, well, this is roughly the same length as the 300 and something day correction you had at cycle wave 2, Tom, so why can't this be done? It could be. It could be close to being done. This could be a double zigzag, whereas the other one was a zigzag, and then we come out and off we go to new highs in an impulse. Problem is, it doesn't satisfy the increased probability of there being a correction, and that's why I'm leaning into the idea of it being a series of zigzags as opposed to an impulse, because the wave degree of saying 1, 2, 3, 4 and then an extended fifth for an impulse just doesn't look right. The three's not the shortest, but it's much shorter than I'd expect it to be, so I'd rather break it down into zigzags and then work on the current price data using classical analysis in the meantime to try and predict, or at least find out where the low's going to be. So we'll come in and do that now and have a look at how we could extend this correction further in time. Okay, so let's just move out again to the weekly time frame for a moment, so we can just remind ourselves of the long-term picture. Bring up our indicators. Okay, so one of the things I've noticed here is everything within this large wave 3, this subway here, this single wave degree into this cycle 3 I'm calling it, we have this trend in the OBV. I have to come down and have a look at it. So this is the subwave 1, 2, 3, 4, 5 essentially, and we can see how this positive accumulation of volume has set a trend. Low here, low here, low here, low here. We've come back to that trend and we've now recently broken it. Also, if we come and have a look at the RSI, we can see how we've recently come from overbought, from the 2020 low, to oversold, to overbought, back to oversold. So we've done a round trip on the weekly time frame. Often a sign that whatever the sell-off that is currently underway is over. Now, it doesn't mean that it can't be part of a corrective structure. This could have been the A on our chart, this could all be B on our chart, and this could then be the C, bringing us back to oversold out into 23, late 23 into 24 even. Okay, it just means that the current move is starting to get a little tired and a little overdone. We can see that we have currently divergence between previous lows and current price. Now, that's not confirmed bullish divergence because it's not low to a confirmed low. We may continue to push down in price. MACD is also displaying over the smaller time frame here that same divergence, having come at very, very negative, big bearish momentum here from that high, building up, crescendoing, rebounding, and now potentially softening. So we've got some divergence here, but it's not confirmed because we don't have a confirmed low yet. We may well come down further in the MACD and the RSI, but it's still looking a little overdone, is my point. So on that note, the longer term count, we bring up that cycle wave degree. What if we're doing, instead of doing another sharp correction like we did here, this is a zigzag. Why I haven't labelled it, I don't know, but it's pretty obviously a zigzag. So let's put that in there, primary degree. So what if we did a sharp here, and now we're going to do a sideways correction here? So it's going to be more time consuming than this one. You could be looking at a double zigzag into an A, because we've got a double zigzag, right? We could then spend a year or 6 months or longer coming back up into a B to a new high, maybe back testing the trend. Okay, and then we could have a violent impulse down in the C back to the edge here. This takes us out into early 2024. So worst case scenario, I'm thinking it could be a long correction, long correction, taking us out in a sideways structure. Right, and then this also achieves the idea of bringing us back into the prior wave 4. So here's the 3-wave swing of the prior wave 4. If we just get a little box around the top of that B wave here and the bottom of that 4, we can see how that brings us into the prior wave 4 as well. That's quite common for a larger wave degree 4 to finish within a smaller wave degree 4, just as this finished within the bounds of the former wave degree 4 and this and this and so on and so forth. So we may do something like that. It's not a certainty by any means, but we have to be prepared for a very unexpected and volatile ride, which could be a push to new highs, trapping as many bulls on the breakout as possible, thinking that we're now off to in a wave 5 just to roll over and set a lower low. That'd be quite distressing, that would, wouldn't it? But these patterns, that's exactly what they do. They're there to basically pull in escape liquidity for those who want to get out, and a new high would definitely serve that purpose. Alternatively, we're close to being done in another sharp and we're going to go off into a new high. So now that we've discussed that, let's just turn off the Elliott wave count for the moment. We'll put that corrective wave into the primary count as well. Turn that off, turn off the correction, get rid of that rectangle. And now let's bring up some simple levels to look at here. So we're going to bring up some fixed range volume profiles. Daily time frame, we can see that we're well below the 60 and the 250 exponential moving average. We haven't had such a nasty crossover on the daily time frame for a very long time. This is why I suspect this is a larger wave degree correction. It is getting very overdone now. It does feel like it's getting quite overdone. I'm not saying that, obviously, if I'm expecting deeper lows to come in the future, I'm not saying we can't go lower on long term, but 44.78% sell-off in Google is pretty big. Now, you've got a lot of people out there at the moment, I'm just going to go fundamental on you for a moment, who are saying US markets are so overpriced they're going to collapse and it's going to be an absolute massacre. I would argue that's unlikely. American markets are not American markets. That's a little silly thinking that way, in my opinion. American markets are global markets, and they draw in global liquidity. And if you look at the larger picture rather than just at the American state of affairs, if you look at Europe and you look at Asia and even emerging markets, and you look all around the world, and then you consider where's that capital flowing. Are people going to sit on cash as it depreciates in value, as their currencies implode against the dollar, or are they going to pursue value in the only market which is going to offer a return, which you could argue is the American market? So American equity markets could well benefit from global capital flows, and I think when you look at the bigger picture like that, I think you get an appreciation as to why the broader indices in the US have only sold off very gradually in a very controlled fashion, gradually stepping down 20 to 30%, as opposed to imploding. Because when we look at the fundamentals for the macroeconomic situation in our leading indicators, things look fucking dire. They really do look pretty bad at the moment, and a lot of the bears are frustrated. I feel that they're not getting the kind of panic event and massive collapse they're expecting, but I feel that for as long as we view the US markets, including the bond and equity markets, as global markets, we get an explanation as to why there's so much universal capital holding the thing together, and that could well continue to be the case. But anyway, that's our moving averages there. We're below the 60 and the 250. We have got our sell-off here, which we've got a fixed range volume profile on. I'm using fixed range volume profile for this impulse to the high. We can see where we've got our points of control. So if we just bring in our support and resistance now, we can see that we're currently at a previous support level. This is a previous high, these are previous lows that were tested, this is a little node of volume. We've roughly fallen into this area here and found a little bounce for the moment. We've got much stronger support down here, series of highs and lows back tested. This is at 75.03. When we come into all of this volume here at this point of control, which overlaps with the volume profile we can see for the visible range on the right hand side, and then we've got lower support below that. We don't really need to consider support below that unless we continue to break down from where we are currently. On the upside, or looking to the upside, we've got pretty strong structure here, as we can see in the as we can see in the fixed range volume profile. All of this is supply. We've got strong resistance level here. These are previous highs that were resistance, becoming support, becoming resistance again. 105.45. A break above this and this downward move, that would be interesting. We could be looking for 5 up and then potentially 3 back as a 1 and a 2, or it could be A and B, C to go higher, but we want to see a move off of the low before we start chasing anything. If we just confirm this by bringing in our demand and supply zones, this is where we've got previous buyers, prices pulled back, found support, found buying volume, moved higher. We're in that zone now, but we have breached it somewhat. We've got a big chunk of it down here where we've moved up, moved back, found buyers, moved up, moved back, found buyers, moved up, moved back, found buyers, and continued on. So we've got strong support, strong demand down here, just as we've got strong supply above us here on the way back up. Okay, where we've moved down, moved back, found sellers, moved down, moved back, found sellers. Okay, so getting into here, any kind of rally off of the low, we're going to find problems in here. That would be a likely place to stop a first move, a 1 or an A, before retracing to find support. So that's really what we're going to be waiting to see. We want to see Google rally, and we want to see if it can break out of this downward trend. We want to see if it can get through resistance, and then we want to be looking for a retracement, because if we suspect A, B and C, we really don't want to miss out on a new high, and we don't want to miss out on the possibility to short a longer term correction either. So that's how the situation looks at the moment. If we just switch off those now then, and let's bring up our momentum indicators on the daily time frame and see if there's any evidence at the moment. So after this recent breakdown, let's come down and have a look. We've got what could be a 1 and a 2 and a 3 and a 4. It could be a 3-wave move, but I'm suspecting 5, so I'm thinking we're going to come down a little bit lower, maybe test this channel. Let's just get a regression channel on this and see how it looks as well. Bear with me, taking that as the high. Okay, So you could argue, let's come off of log. Using the regression channel from the high to the current low. We may have done enough down here, but I suspect maybe breach the channel and come down a little bit lower one more time to complete 5 waves. We've got oversold conditions on the daily time frame. We've got this downward trend now in the OBV. This is another thing we'd like to see break as well, going back to the upside. If we can break this downward trend and start accumulating positive volume on the way back up, breach this channel, get an impulsive move, pull back, find support. Likely if we do break the channel, we'll come back into this area here to find support before moving off again. We need to see positive momentum in here. We need to see a new overbought reading on the RSI. We need to see a break of this downward trend in volume. We need to see an impulsive move, and we need to see some volume come in behind it. We got volume at the lows coming in. High volume in the sell-off move. This can be a sign of capitulation. It's no more impressive really than prior moves down though, so maybe it isn't yet. If we start to see on the weekly time frame a positive close for a weekly candle with a push from volume, we can start to get a bit bullish, but we're still trending down in the MACD, still trending down in the RSI, still trending down in the OBV, so we've got to wait to find a bounce before we could get bullish. And I think if you're shorting at this point, and you're shorting into weekly oversold conditions, daily oversold conditions, negative volume, and increasing volume into a low, I think you're being a little greedy and should probably lighten up at this point, as a violent breakdown from here is far less likely. If you get a retracement inside of this channel, we don't go bullish, then a further breakdown could be violent and could be possible, but right now here I think we're getting a little late in the day to be short. Probably should really start thinking about a possibility of a rebound. Okay, that's basically how I see things at the moment. So correction wise, I'm thinking 5 waves down in a C. That isn't done yet. We've got a bit lower to come. I'd like to see bullish divergence at the lows. I want to see a move off of the low. I want to see all the things I mentioned before I get bullish here, but I do feel that a longer term correction, a flat or some kind of sideways correction to counter that that violent sharp correction at cycle wave 2 degree could be on the cards. But you know, you don't want to miss a B wave rally into new highs, do you? Especially at this scale. So I think looking at the classical analysis for the moment, keeping an eye on those support levels, looking for positive momentum and volume to accumulate, looking for a push from volume, looking for a positive daily close on the candle, and a weekly close, looking for all of these things to find signs of a low incoming. Last thing I want to just put on the chart is the Fibonacci retracement level. So we're just going to come up to the high here and switch this over to my wave 2. Here's the golden zone. We've just breached it to a new low, but we've come to it. If you breach the golden zone, the 61.8, 65, it's likely going to try and push a little bit lower. We've got the point of control bang on the 78.6% retracement, so maybe we go 1, 2, 3, 4 and we push a little lower down to 72 region here. And then we've got that first double zigzag complete before we push to new highs. Either way, whether it's a sharp and it's completed and we go to new highs, or whether it's an A and we've got a B to new highs, I think when it bottoms, a significant bounce is coming, and it's probably going to take a lot of people by surprise because everyone's getting so bearish at the moment. The market can rally under extremely bearish circumstances, believe it or not, just on technical matters, and we're getting close to pushing those technicals to an extreme here at the moment. Alright then guys, I hope you've enjoyed that. If you're new to the channel and you've liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, a huge thank you to my Patreon subscribers. If you're interested in joining the Patreon, there's a link in the description box below. Follow it, have a read of the tiers, feel free to sign up. It's still early in the month, and if you're not following me on Twitter yet, there's a link to my Twitter feed as well. I only really post videos on there, I don't really chat or anything, but it's just there in case people miss their YouTube notifications. Alright guys, take care of yourselves, and I'll be back with you later in the week. All the best, bye bye.